Hi, I'm Mike Gassewitz, CEO of IAIC, and welcome to another episode of In Focus. Joining me today is Nick Leach. Hi, Nick. Welcome.
Hello, Mike.
Great to have you on. Nick is our portfolio manager responsible for our income-producing portion of our portfolios. And so, Nick, and again, just for everyone listening, income-producing is basically bonds, pref shares, real estate income trusts. And so why don't we, I'm basically asking every one of the sector leads, what did 2022 look like from, Q4 and for the whole year? What did that look like from your perspective?
Oh, it was terrible. I mean, if we look
Nice.
back at 2022, it was really an unprecedented year. A massive spike in bond yields as the central banks aggressively raised their policy rates to fight inflation. Here in Canada and in the US, you had the Bank of Canada and the Federal Reserve. They increased their overnight policy rates from 0 to 4.5% at an unprecedented pace. On top of that, it wasn't just Canada and the US. Central banks around the globe also raising their rates, all simultaneously. That's also unprecedented. So all that led to historic double-digit losses in the bond market, in the pref market, and in the REIT market. And as everybody knows, in the equity market, it was very disruptive in the equity markets as well. But for the bond market in particular, most of those losses occurred in the early part of the year, because that's as the bond market actually started front-running the actual central bank moves. So then towards the end of the year, yields started to stabilize because there were signs that inflation was peaking.
Okay. There's this thing called the yield curve. Let's maybe just quick tutorial for the folks.
Sure.
What's the yield curve and what does it look like and what does it tell us?
Okay, right now, the yield curves in Canada and the US and around the world, they're inverted. And an inverted yield curve occurs when long-term interest rates are below short-term interest rates, and that's very unusual.
Right.
We normally have upward sloping yield curves, and they're actually called normal yield curves if they're upward sloping, and they're the norm for good reason. Most importantly is that the future brings uncertainty. The future is more uncertain than the present, and investors demand a risk premium for taking on that additional uncertainty.
Right.
And also, if you look at long-term bond prices, they're more volatile than short-term bonds. And that's just simple math. So you have more volatility, that brings more risk. So investors and lenders demand higher compensation for taking on that risk. However, you look at today, bondholders are getting paid more for taking on less risk. If you look at the Government of Canada bonds, the overnight rate is 4.5%. The one-year bond yield is 4.5%. The two-year bond yield falls to 3.7%. And then going out to 10 years, it falls to 2.9%. So why is this happening? So if you look at the short-term yield, the one-year bond, it's really anchored by central bank policy, by the Bank of Canada. And that's currently at 4.5%. So what's happening is the bond market is predicting that the Bank of Canada will lower interest rates. And why would they do that? Typically, it's to stimulate an economy that's in a recession. Right. But Mike, as we all know, like the last few years have not been typical. They've been more like atypical years.
Right. Okay. So you talked about inflation, yield curve. So put you on the spot. Have we, from your perspective, do you think inflation has peaked?
I would say from my observations, yes, Mike, it definitely peaked in the summer. If we go back to this summer, the annual inflation rate, it was running around 9% in the US and 8% in Canada. Most recently, it came in Canada and the US, both at around 6%. And keeping that's an annual rate, and it's that's somewhat backwards looking. So because it includes monthly inflation that was occurring about 12 months ago, or up to 12 months ago. So if we look at the monthly inflation rate, like the month-over-month inflation rate over the last 6 months, and we take those 6 months and we annualize them, in Canada, we're running at 0.4%. That's well below the central bank target. And in the US, it's running at 2%, which is right on target for the Federal Reserve. And then also on a daily basis, everybody can see what's happening with house prices in Canada and the US, with car prices, new and used, with shipping costs and commodity prices. Although they are volatile, there are indications that inflation is heading in the right direction.
It's nice to see some policy working. So, okay, so let's talk about now 2023. What are your views, outlook for 2023 in the income producing side of our portfolios? Yeah,
so if we look at what the yield curve is telling us, as I said, the bond market is pricing in for future rate cuts. And as I said, central banks typically cut rates in response to a recession. But if we look at the credit markets aren't pointing to a recession. Credit spreads have actually been declining recently, and right now they're sitting around a historical average. And if we look at the U.S., even some of the riskier areas of the credit markets, they're back to pre-COVID levels.
Okay.
And these companies are highly more sensitive to the economic cycle, and we're not seeing any stress in the credit market. So if a recession was imminent, credit spreads would be much higher than where they are today. So if I were to pick a side, Mike, I would go with the credit markets. I look at 2023, and we're getting closer to pre-COVID normalcy. And if you remember, pre-COVID, inflation was too low. It was well below the central bank targets. So if inflation gets too low, the central banks may have to reverse some of these aggressive rate hikes that we've seen. So we could see lower rates in the absence of a recession. And then even just this morning, the all-important non-farm payrolls numbers came out, and we saw a very, very strong jobs report in the US. But importantly, alongside that, we saw slower wage growth, which bodes well for inflation.
Right. Okay. Well, thanks for this, Nick. Appreciate you chatting with us.
All right. Nice chatting with you too, Mike.
Folks, as always, if you have any questions, don't hesitate to reach out to your portfolio manager or your accounting firm advisor. Take care.